the Fed has no fiscal authority whatsoever. The Fed does not spend the taxpayers' money. What the Fed is doing is providing short-term loans. Central banks throughout history have responded to banking panics by providing short-term loans to banks so that they could finance themselves until the depositors came back, basically. This is something that's been going on since the 1700s. So during the crisis, as short-term financing was being withdrawn from financial institutions, and this was electronic financing rather than depositors lining up at the window, these institutions needed financing, and what the Fed did was make collateralized loans, make loans to these institutions, took collateral that allowed them to survive the panic, and as things calmed down, they repaid the loans and they got back to normal financing, and that's what happened. So there was no spending of the taxpayers' money involved. It was short-term loans, and every single one of them was paid back with interest. Quantitative easing just involves the Fed buying Treasury securities on the open market, and they're paid for by crediting the bank accounts of the sellers, and so they end up appearing as reserves that the banks hold with the Fed. So it's a circular process in that respect. It does not involve any money printing. The amount of currency in circulation is determined by what people want to hold. It does not involve any spending of the taxpayers' money because it's a purchase of an asset, a security, which pays interest and which has value. And at the appropriate time, that security either matures or it can be sold back and the money is recovered. In fact, again, the Fed is a very profitable institution. It's been in the sense that it earns a lot of money on the assets that it holds, the interest on the assets that it holds, and all that money after expenses, after the cost of running the Fed is taken care of, the great bulk of that money goes back to the Treasury and reduces the government deficit. So it's actually a profit center for the government rather than a drain on the fisc. Every commercial bank has got an account at the Fed, basically. So the same way you have an account at a corner bank, banks have accounts at the Fed. So the way the securities are paid for is by just crediting the accounts that the banks have at the Fed by the same amount, by the purchase price, and that in turn appears in the checking accounts or whatever of the sellers. So that's how it's paid for. It's all electronic. Suppose you think about the government as a whole. Think about the Treasury and the Fed as one single institution. All that's happening is that this collective of the Fed and the Treasury is doing the same amount of overall borrowing that the government has to do, but doing it more in short-term borrowing rather than longer-term borrowing. So what quantitative easing is basically is that the Fed is swapping out bank reserves, which are very short-term liquid assets, in exchange for longer-term 5-10-year maturity Treasury securities. It is just as if the Treasury had announced that it was going to borrow more in the short-term market than the long-term market. That's all it is. Right. By the way, it's unfortunate that the Fed has been really the only game in town in terms of providing support for economic recovery, both substantively because you get a more balanced and stronger recovery if there had been more support from other policymakers, number one. But number two, because there's this view out there that because the Fed is the only agency which is really doing much about recovery, that anything that's bad about the economy, even if it's things that the Fed has absolutely no control over, like growing inequality in income, for example, that it must be the Fed's fault. And that's bad, obviously, for the institution and bad for economic policymaking.